In this video, we're going to briefly go through modifying Polaris valuation inputs indirectly using the sales growth slider. There is a whole series on the Polaris valuation that covers each input value into the valuation Polaris valuation formula, a separate video for each one. So I invite you to go watch that series that's out there under the closer looks videos. But this is just a more brief way that or focus on modifying the other values besides sales growth using the Polaris website. So if you're out there using the website, if you have some strong opinion outside of sales growth that involves either future shares, profit margin, PE, the cost of capital, which here is 6%, or even the length of time that you're going to expect a company to stay in a more volatile situation and then eventually stabilize into more, and then calculate a terminal value from as a result of that stabilization. But if you think that period is going to last longer, shorter, we'll also talk about how to change the sales growth or modify the sales growth slider to accommodate for that change in opinion about how even long this competitive advantage period may last. So we'll be coming back to the website and showing how to make these modifications, but to remind you from previous videos that this is the formula used to calculate present value of the valuation. The inputs that are used by the formula are these 6 inputs. Sales growth, obvious one that's built in right into the site to conveniently allow you to move the slider around, and that slider impacts directly the theoretical valuation, and then a reminder, the practical valuation and investment return as a result of Polaris taking into account both the market realities and the academic or theoretical valuation and arriving at some practical valuation. But we're going to be focused on the input parameters that impact the theoretical valuation in this video. So one is the sales growth slider, and then 3 out of the next 5 are down here under future shares, profit margin, PE, and like I already mentioned, we have the cost of capital is 6%, and then I just have to tell you that at the default term for the competitive advantage period is 5 years used by Polaris. That's one reason why this value here shows initially as 5, even though it's unrelated to the valuation. At least hopefully it will jog your memory if you're wondering about how many years is Polaris assume that a company stays in this initial kind of volatile stage, and it is 5. So let's talk about how you would modify some of these. Let's say that your opinion about the profit margin is different than what the default value is, and you have a fairly strong opinion about the profit margin. So here we have a profit margin of 9.8%, but let's say you believe that the profit margin is more like 10.5%. How would you enter that in using the Polaris website? Well, here's a fairly complex looking, it's not complex really, but it's complex looking formula that shows you exactly how the modified sales growth or the slider, how you would have to modify that value in order to accommodate a change in opinion of profit margin or PE or number of shares, the growth of shares and the cost of capital, things like that. There is an approximation, but the main thing about the approximation is it allows you to just simply take the existing sales forecast and add something to it or subtract if it ends up being a negative number. But instead of having to multiply, it's just a simplification, approximation that lets you use addition instead. So let's go through the example, or before I go through a specific example, let's look at the two different approaches that you're going to have anytime you want to make a modification. So we're looking at 9.8 profit margin, and we're assuming maybe a profit margin more like 10.5. So how much of an increase are we looking at? When we go we're looking at about a 7% increase. Well, one approach would be to do the math and get 1.07 then take 1.07 to the number of years that is being used in this volatile period, and like I said, Polaris defaults to 5 years. So you take it to the 1/5, and you find a value that you would add on to the um, existing sales growth assumption, and modify the sales growth accordingly, and you would see what the valuation is. Well, let's go ahead and do that math. It works out to see, to the 0.2 power is about 0.013. So I would add a very small number for a 7% change in profit margin. I would change the sales growth only by 1.3%. So I come over here, and it's hard to change the sales growth by so little, but I would up it to like 7.7. Now I'm not going to be able to get there, but I like 7. Okay, let's go back to the default. It really doesn't even change the theoretical, and it only slightly changes the, or it doesn't change the practical, only slightly changes the theoretical from 13.3 to 15.5 investment return, and a theoretical value of 25.62, and then we change it down to 7 to 28. So it's $2-3 change. Well, another way you could see this, do it an equivalent way, is you can just say, well, I know it's a 7% change in valuation by just taking my opinion about profit margin compared to the default, and so you just you look at what the default with the sales growth slider at the default. What is the theoretical value if it goes up by 7%? Well, that's roughly 27.41. So you can just move the slider till you see 27, or as close as you can get by the sensitivity of the slider. And yeah, now you see the theoretical investment return is about 15.5. Practical is 10.9. So it's very similar to the other approach. It's actually my preferred way of doing it, as opposed to always getting some very specific value to add to the growth and then move your growth slider around. I think for this exercise, and when you're trying to use a growth slider to approximate changes in other input values, you're probably better to go with this approach over here, where you just look at the change to the valuation and then move your slider around accordingly to see what the eventual impact is to practical. And that's really what you want to know is if you were to choose to invest in this stock, what practically could you hope for in terms of evaluation? Well, instead of flipping back and forth to the website, let's just go down here and do some examples. Let's say that share growth was something that you want to change. Well, the growth for Hanesbrands right now is -9%. Share growth is defaulting to -0.4. So repurchasing, let's say you, the user, think that instead of repurchasing, they're going to issue shares. Over here, you see the math, just what you would do, plug in the numbers, and you would get a -13%. An equivalent approach would say plug in those numbers, and you can say, well, the valuation is going to change by about 0.74. So I go back out to the site, and I can either move this to 0.13 or leave it the same and modify this by 0.74, and that's roughly $19, and then I would just move this down until I got to 19, and yeah, it's about the same in terms of how much what was recommended with the other approach in terms of changing the or modifying the growth. Profit margin, I'm going to go through a lot quicker. You do the same thing. You get either a -17 total growth that you would move the slider to, or you would just use 0.6 of the current valuation with the slider set to the default, and then you just move the slider till you get to what is 0.6 times 25.2. You would just move the growth till you get to about 15.3. And that difference is 11% between the default, and that's what you would likely get if you were to go through the math as well. So last example that I'll show here is if you wanted to change two values at the same time. Let's say you want to change profit margin and share growth. Well, you do the same kind of approach that we've talked about. It's just multiplying the two results together. Like you have 6.61 times 0.674, then you get quite a change in valuation if you assume that share growth is going to go up instead of down, and the profit margin is going to go down. And all right, one last thing I wanted to show you is if you were dealing with extreme stocks like Tesla and Netflix that have quite a different future ahead of them than what they're currently operating at, 5 years may not be sufficient enough time to give these companies the situations to play out. So you would want to up the number of years that you're looking at. Using the approach where you just look at a modified valuation and then move the growth slider around, the way you come up with that modification of factor of the valuation is a little more involved. You've got to take the growth that you're assuming and dividing by the share growth and the cost of capital, and then take all that result and multiply it, or take it to the exponent of, let's say you want to do 7 years versus 5 years, that would be 2. So you would take it to the second power. If you wanted to do 3 years, you take it to the third power. But the reason that's a little more involved, if you think about it, is if you're going to go further out in time, from 5 years to 7 years, okay, you've got to let the growth run for 2 more years. But as you let the growth run for 2 more years, you're getting 2 more years of sales growth. So you've got to put that in the denominator. And then eventually when you discount it back to the present value, you've got 2 more years of cost of capital that you've got to take account. So when you think of it that way, it's fairly straightforward. Growth in the numerator, share growth, and cost of capital in the denominator. All right, thanks for listening.